The Engulfing Candlestick Pattern, Complete Guide. What is an engulfing pattern? An engulfing pattern is a two-candle reversal signal that tells you the market is changing direction. It shows a complete shift in control from one group of traders to another. The core concept. The first candle shows a weak effort, small body. The second candle shows a strong counterattack, large body that completely covers the first. Result, a potential trend reversal. Pattern structure, how to spot it. The two-candle setup. First candle on the left. Has a small body. Shows weak momentum. One direction is tried. It has failed to dominate. Second candle on the right. Has a large body. Shows strong momentum. Opposite direction wins. The golden rule. The second candle's body must completely engulf the first candle's body. Wicks do not need to be engulfed, only the bodies matter. The body rule, very important for beginners. What counts as engulfing? Ignore the wicks of the first candle. Focus on the small body of the first candle. Ignore the wicks of the second candle. Focus on the large body of the second candle. Body covers body means valid engulfing pattern. Wicks sticking out are completely normal and acceptable. Wicks do not need to be covered. There are only two types engulfing patterns. Bullish engulfing forms in a downtrend. Bearish engulfing forms in an uptrend. Type 1, bullish engulfing pattern, where it forms in a downtrend. Downtrend in progress, the price is falling. Sellers tried to push the price further down but showed weakness. A small red candle appears on the chart. Buyers push back with force. A large green candle appears. It completely covers the red candle body. A potential trend reversal from downtrend to uptrend. What it looks like. In the downtrend, the price is falling down. A small red candle appears on the chart. Sellers push the price down, but they are weak. A large green candle, buyers push the price back up, they are strong. The green candle body completely covers the red candle body. The opening price behavior, why it matters. Bullish engulfing, price movement. First candle, opens higher, closes lower, red candle, sellers in control. Second candle, opens at or below the first candle's close. Then it closes above the first candle's open. Why it matters. Opening below shows initial selling pressure continued. Then the strong close above proves buyers completely took over and dominated. This full price sweep is what confirms genuine buyer strength. What it means? Sellers failed to keep prices down. Buyers stepped in with force and reversed the entire move. Buyers now have control of the market. A trend reversal upward is now possible. Bullish engulfing pattern signal strength by location. Strongest at the bottom of a downtrend when the price is falling. During an uptrend, a moderate pullback entry signal. Bullish engulfing during an uptrend pullback. An uptrend is in progress, the price is rising. Price rise temporarily pulls back. Small red candle appears showing a brief buyer weakness. Then a large green candle appears. Uptrend continues, the price keeps on rising. What this means? This is a pullback entry opportunity. It is not a reversal signal in this location. Traders use it to join the existing uptrend at a better or cheaper price. The trend was never truly threatened. Why it's most powerful at downtrend bottoms. When a bullish engulfing forms after prices have been falling, it signals capitulation. Sellers have completely exhausted themselves. Buyers overwhelm them so completely that they reverse the entire move. This is one of the most trusted reversal signals in trading. The psychology, bullish engulfing battle. In the downtrend, sellers attack first. They push price down. They create a small red candle. They appear to be in control. Buyers counterattack. They open at or below where sellers closed. They reject the lower prices completely. They push price back up strongly. They push past where sellers started. They completely erase all of the selling. Result: buyers won the battle. Sellers are exhausted and demoralized. Trend reversal upward likely coming. Type 2, bearish engulfing pattern, where it forms in an uptrend. An uptrend is in progress. The price is rising. Buyers tried to push the price further up but showed weakness. A small green candle appears on the chart. Sellers push back with force. A large red candle appears. It completely covers the green candle body. A potential downward reversal, the price will fall. What it looks like in the uptrend. Small green candle, buyers push the price up but they are weak. Large red candle, sellers push the price back down but they are strong. Red candle body completely covers the green candle body. The opening price behavior, why it matters. Bearish engulfing, price movement. First candle, opens lower, closes higher, green candle, buyers in control. Second candle, opens at or above the first candle's close. Then closes below the first candle's open. Why this matters? Opening above shows initial buying pressure continued. Then the strong close below proves sellers completely took over and dominated. This full price sweep is what confirms genuine seller strength. What it means? Buyers failed to keep prices up. Sellers stepped in with force and reversed the entire move. Sellers now have control of the market. A trend reversal downward is now possible. Bearish engulfing signal strength by location. At the top of an uptrend when the price is rising, a bearish engulfing pattern gives a strongest capitulation reversal signal. During a downtrend, a pullback signal indicates a moderate entry. Bearish engulfing during a downtrend pullback. Downtrend is in progress, the price is falling. Price pulls back temporarily. Small green candle appears, brief buying. Large red candle appears, downtrend resumes. Downtrend continues. What this means? This is a pullback entry opportunity. It is not a reversal signal in this location. Traders use it to join the existing downtrend at a better price. The trend was never truly threatened. Why it's most powerful at uptrend tops. When a bearish engulfing forms after prices have been rising, it signals that buyers are exhausted. Sellers come in so strong they reverse the entire move. This is a critical warning that the uptrend is ending. In the uptrend, buyers attack first. They push price up. They create a small green candle. They appear to be in control. Sellers counter attack. They open at or above where buyers closed. They reject the higher prices completely. They push price back down strongly. They push past where buyers started. They completely erase all of the buying. Result: sellers won the battle. Buyers are exhausted and demoralized. Trend reversal downward likely coming. Volume confirmation, critical factor. Volume tells you how strong the signal is. Strong signal. When second candle's volume is greater than first candle's volume. Genuine strength and conviction behind the move. Big money, institutional traders, is involved. Much higher probability of follow-through. Weak signal. When second candle's volume is less than the first candle's volume. Less conviction behind the move. Be cautious, wait for more confirmation. False signal warning. When second candle's volume is less than the first candle's volume. Very suspicious, lack of real participation. High probability this pattern will fail. Avoid trading this setup. Simple rule to remember. High volume engulfing candle means big money agrees. Low volume engulfing candle means be very careful. Engulfing pattern versus other reversals. Why engulfing is special? All engulfing patterns are reversal patterns, but not all reversal patterns are engulfing patterns. Other reversal patterns, not engulfing. Hammer. Shooting star. Morning star. Evening star. What makes engulfing unique? Other reversal patterns. Show hesitation or indecision. Suggest a reversal might happen. Engulfing pattern. Shows complete domination. Second candle does not just reverse direction. It completely erases the previous candle's entire price range. This total dominance is what makes it more powerful and more trusted. When engulfing patterns work best. An engulfing pattern is most reliable when all of these are present. First candle is genuinely small. Not just slightly smaller, clearly weak. Second candle is genuinely large. Strong momentum, clearly dominant. Pattern appears after a clear trend. Not in sideways or choppy markets. Pattern appears at trend extremes. Bullish engulfing bottom of a downtrend. Bearish engulfing top of an uptrend. Volume on second candle is higher than volume on first candle. Nearby support or resistance level present. Gives the pattern a logical location. When engulfing patterns fail. Situation 1. Choppy or sideways market. No clear trend means the pattern has no context. Price moves randomly in both directions. Engulfing patterns appear frequently but mean little. Solution: wait for a clear trending market. Situation 2. Low volume on second candle. No institutional backing behind the move. The winning side lacks real conviction. Pattern is very likely to reverse and fail. Solution: only trade high volume engulfing candles. Situation 3. No support or resistance nearby. Pattern needs a logical price level to format. Random location in open space equals weak signal. Solution: look for patterns at key price levels. Situation 4. Against the bigger time frame trend. Example: bullish engulfing on daily chart, but the weekly chart shows a strong downtrend. Higher time frame trend almost always wins. Solution: always check the bigger picture first. Situation 5. Too many patterns back to back. Multiple engulfing patterns appearing repeatedly. This signals choppy, indecisive market conditions. None of them are reliable in this situation. Solution: step back and wait for clarity. Critical trading rule. Never trade engulfing patterns alone. An engulfing pattern by itself is not enough to enter a trade. You must confirm with additional factors. Is there a nearby support or resistance? Is volume higher on the second candle? Is the pattern at a trend extreme? What does the bigger time frame show? Are other technical indicators aligned? Confluence. Multiple signals all agreeing together. A much higher probability trade. What separates good trades from bad ones? Why? Not every engulfing pattern leads to a reversal. Some fail completely. You need confluence to trade safely. What is engulfing? Small body of the loser. Large body of the winner that eats it whole. Where they form. Bullish equals forms in a downtrend bottom. Bearish equals forms in an uptrend top. Body rule. Only bodies matter. Wicks are ignored. Volume rule. High volume means strong signal. Low volume means be very careful. Trading rule. Never trade the pattern alone. Always wait for confluence. Key takeaways. Engulfing patterns equals two candle reversal signals. They show complete control shift from one side to another. Bullish engulfing forms in a downtrend bottom. Bearish engulfing forms in an uptrend top. Only bodies matter for the engulfing rule. Wicks do not need to be covered. Second candle volume should be higher than first candle volume for best results. Most powerful at trend extremes. Tops and bottoms, not random locations. Within a trend equals pullback entry signal. Not a reversal, joining the trend. Never trade without additional confirmation. Support, resistance, plus volume, plus trend context. Know when patterns fail. Choppy markets, low volume, no key levels. Pattern identification is your first priority. Master spotting them before thinking about trading. Remember, your only job right now is to become an expert at finding and reading these patterns on charts. Trading comes later, recognition comes first.